Imagine you have spent your entire life building a property business. You started with one property, then another, and over the years, you have built a successful business which generates substantial cash flow. You even turn some of your properties into service accommodation. So, unlike normal rental business, you are providing additional services to your customers. And naturally, you will expect then whenever you die, your children can take over your legacy. Okay, they can take over what you have spent your entire life building. That's where business relief can become incredibly important. BPR can potentially reduce the inheritance tax burden when a qualifying business is passed on to the next generation. But there's one catch. If HMRC considers that your business is an investment business instead of a trading business, the relief can be restricted or denied. And suddenly, a business you have spent decades building can create a significant IHT liability for your children. In the worst case, there are chances that your children, the family, could even face the difficult situation that they would need to decide to even sell the property just to pay off their IHT bill. And this isn't just a theoretical case. In this video, we are going to look at what really business property relief is, what is the thin line of difference between the trading business and investment business, how the relief works, and the major changes that we have seen from 6th of April 2026. Okay, and I recently came across a recent Upper Tribunal case which involved a serviced office business, which is Beresford versus HMRC. So, because whenever you talk about BPR, it's not just enough to say I run a business. The question is, what kind of business are you actually running? So let's get started with the big question. When does a property business qualify for 100% IHT relief? Okay, this is what we are going to see today. So this particular case started with, it was taken to FTT, First Tier Tribunal, and they ruled out the decision against the executors, and the executors challenged the decision, and this case was taken to Upper Tribunal, and the Upper Tribunal gave the judgment on 29th July 2026. So this just happened a month ago, right? A month ago, yeah. So we are going to see what was the logics and what was all the sort of things included in that. Okay, what are we covering? Firstly, we are going to see what is BPR, and then we are going to see the facts of the case. Okay, and we would see the legal test, how you are going to check if a business is an investment or trading business, the decision of FTT, what was the appeal, the outcome, and the lessons. Okay, so this is the agenda of today's video. Starting with the first thing, Harsh, what really is business property relief? Okay, so whenever someone dies, they have certain assets, certain properties, which then is taken over by the other generation. Okay, now they would be paying 40% IHT after all sorts of relief that has been applied. You have NRB, you have residential rate band. So after all sorts of relief, whenever you transfer your property, you are going to pay 40. The childrens, okay, are going to pay 40% of tax. Okay, so with the business property relief, what happens is that if you have a relevant business property, see, in double inverted comma, focus on it, relevant business property. Most important thing, if it is for relevant business property. So if you left relevant business property, if you left relevant business property to the next generation, you are going to get 100% relief from inheritance tax. Okay, you are going to pay no inheritance tax. See how good the relief is. Okay, it is one of the most valuable inheritance tax relief that is available. Uh, we are going to see what Section 104(1) IHTA 1984 covers, and the major section we are going to cover. Okay, so in practice, what this means is that as a family trading company, you can pass to next generation with no inheritance tax bill at all. Okay, there is a huge incentive for the families to continue generation over generation the same business, to continue the trading that they have been doing. Okay, see, the catch here is that relief is denied if the underlying business is wholly or mainly one of the excluded categories below. We are going to see what are those categories. But yeah, first let's understand why this relief was given. Okay, say I managed a manufacturing business. Let's say manufacturing business. Yeah, let's keep it that way. Okay, so I own a manufacturing business. I almost spent my entire life, I did everything what I can do. I built my relationship with suppliers and customers. My business is running really good. Okay, and the government, HMRC, is also earning good hits from me because I'm earning profits and I'm paying to them. Okay, but what if I die? What if the owner dies? Okay, what if the owner dies? Sure as hell it would then transfer to the person that they have in the will. Okay, so when that gets transferred, if that person has to pay 40 percentage of IHT, 40 percentage of IHT, there are chances you would even need to sell the business to just get the cash flow, because see, 40 percentage is used. So let's say if my property's worth is 100 rupees, I'm going to pay 40. Okay, I'm firstly going to pay 40. Keep it aside. Let's say if your business, let's say here in our case, the business is profitable, it's fine. You can have it from the cash flow and you can have it from the reserves. But let's say if I'm a loss making business, let's say if I'm a loss making business, I have negative cash flow, how would I get this much amount of money? How would I get this much amount of money? There are chances that I have to force sell my company. I have to force sell the company. Okay, there would be no existence then for the company. The thing that has been built from the last many years would not remain into existence once I die. Okay, and see, there is a uh, thing that government would always want the businesses that are in the country to be there. Okay, they increase job. Okay, they have the main thing is that it gives them the taxes. Okay, so government wants to incentivize the businesses to continue trading. Okay, even if someone dies, whenever the other person inherit, it should continue. Business should continue. Okay, this is why business property relief comes into play. Okay, moving on to next one. What is the trap here? What is the trap? Let's see. Okay. What does section 1053 says? This is one of the most important section of our whole case. The relief is switched off where the business consists wholly or mainly of one or more. Wholly, okay, fully or mainly. See, it is not like that a business should be completely that, okay, but it could be also mainly, okay, majority, the material part, okay. So if material part of the business or wholly, okay, is one of more, either you are dealing in securities, stocks, or share, okay. So if that business was dealing with stocks, securities, and shares, the relief won't be available. So what kind of business it is? Let's say you do investment in stock markets, you do trading. Okay, you earn profits when shares go up. You invest in bonds and all this too. So it is sort of an investment thing, right? Okay, you invested your money. Okay, it's not trading. It's not actually trading. You have been investing the money, right? And what we want is to save trading businesses to close down. Okay, we want to save trading businesses, right? Another one is if you are dealing in land and building. If you are dealing in land and building, if you frequently sell and purchase land and building, the main motto of your business is to carry out dealings in land and building, the relief would be switched off. You won't have any relief. Making or holding investment. This one is the case that we are going to look at. So if you have been making or holding investments, so for, let's say, for property business, if I purchased property, then I rent it out, okay, it's a rental business. I invested my money, I'm getting the rentals, I'm getting the returns from it. It is making or holding of investment, right? Why this matters for property business? So a company that owns lands and let it out is on the face of it holding an investment. So if you just own land, you purchase land and then you let it out, it is an holding of investment, right? It's not trading. You are not doing any kind of trading here. You just invested your money. But many businesses are built around property. It doesn't mean just because you own a property and you carry out a business with it. It should be an investment. It should be an investment business. It is not like that. If your whole business is your existence of the business comes around the property, let's say you provide serviced offices, you have holiday lets, you open a hotel, okay, hotel, right? You have a storage, you have a livery yards, anything, and you provide real services. You are providing services. You are getting paid for the services instead of the space that you are giving to the customer. Then, in that case, that would be classified as trading activity. Okay. The hard question is, where does ordinary property lending ends? So how we are going to draw the line between them and when you are going to see a trading business? Okay. So let us firstly draw from here. See, there are three kinds of property businesses that you will see. Firstly, you have base letting. Sorry, bare letting. Sorry for that. You have bare letting. In bare letting, it is normal rental business. Tenancy, no, not much activity. Okay, you are just giving tenancy. You are just giving your property to tenants. This is just bare letting, and this is clearly on the investment end. Obviously, this won't qualify. Obviously, this won't qualify. Okay, you just purchase the property and you are getting the rental as a return. Okay, it's an investment activity. Okay. Next, you have managed letting. You are managing the properties actively. Okay. But still, it would be an investment. Okay. Managing property means you are having proper refurbishment so that you can let this out to the prospective clients. Okay. Just to make the property ready to be let out. Okay. You have been actively managing. You are keeping the property to date, let's say. Okay. You are keeping the property at the current level. Okay, you don't want to deteriorate the quality of property because you want to then let it out. Okay, you want to then let it out. Next one is we have done managed letting. We have service led trade. Okay, this one goes into the trading end, which we are into the right side of it. Left hand side bare letting. Middle we have managed letting. Okay, which is sort of in between. Okay, then we have trading end, which is completely trading business. Okay, land, where land is just a platform for you to trade genuinely. Okay, there, this is the point. This is the point where you are going to get the relief. If you fall into the trading end, you are going to get this relief. Okay, where does 9 court serviced office fit? Okay, we are going to see what nine court is and how what was the business actually. So the question was, uh, that really was a big question where in this whole spectrum, this particular case lied. Okay, tribunal wanted it. So tribunal said that it should be on investment side. Let's see why it should be on investment side and what was the thought process behind the executors to consider it as a trading activity and that they should be allowed for the relief. Okay. There are five principles that tribunal relied on. Okay. We are going to see the structure next. Okay. Firstly, the five principles that tribunal relied on. Okay. No presumption. There is no rebuttable presumption that a property business is investment. Okay. Person set. So they said that we are just going. So this person is another trading case. If you want, you can read this whole detailed case. You can get into the HMRC portal. Okay. You will get all sorts of case that have been there, and you can download it. It's a really lengthy one, and you will get sick of it when you read it because it is really, really long and it's in lawyer's language. Okay. Okay. So they wanted to start with the thing that a property business can be an investment business. Okay. So these are sort of references that they have given. Next is active management does not equals to trading. An investment can be actively managed. So for you, if you are finding tenants, okay, if you are finding tenants to let out your building, you are maintaining the property, you are arranging the lease without losing its investment character. So every sort of thing, this is just to get the rentals. Okay, it is not active trading. It is just normal course of investment, but just you are actively involved in it. Okay. Next is extra services rarely tip the balance. See, cleaning, heating, lighting, and similar services do fall into service business. They agreed, right? The tribunal agreed, but it should tip off the balance. It should be material enough to for the business to qualify for this relief. Okay, to be qualified as a business property, a trading property. Okay. Next is look at the business in the round. Okay, we are going to see all the factors instead of one factor. We are going to see what the context was, what the business was doing, the capital employed in the business, staff time, the turnover. So for a property business, so let's say if you are in a hotel business, the turnover is really quick. Your guests are staying for 2 or 3 days. They pay to you for 2 or 3 days whenever they stay. Okay, you are providing them service. This is actually a trading business, right? This is actually a trading business. So see, the turnover is really quick. In a month, you will get around, let's say, 10 to 20 to 30. Okay, customers in the same room, in the same space. Okay, so as per the turnaround time, okay, as per the turnover, okay, as per the so both the things would apply here. Firstly, turnaround time. Okay, for turnaround time, okay, the way property is moving faster, you are switching people. This would go into the trading end. But when I'm getting a monthly rental income for the space that I have provided to someone, is going to be on investment side. Okay. Turnover. See, the case that we are seeing has two distinct areas. Okay, we have two areas. Firstly, we are doing a normal investment business. We are going to see in the cycle in the next slides. And another one is service-led business. Okay, so we can also have a factor called turnover here. So how much is the sale for investment business? How much is the sale for service-led business? And in service-led business, what was the sort of income that you are getting just because of the land you own, or the income that you are getting because of the services that you have been providing? Okay. Trade, next point is trade does not automatically win. Even where a part of the business is genuine trade, the business as a whole can still be mainly investment if the trade isn't the dominant activity. As I said, materiality is a big factor. See, wholly and mainly, I highlighted that thing. Wholly and mainly is really an important thing that you need to consider. Okay. So moving on to the next one. See the corporate structure. How does it start? So the property was of Keith Beresford, if I'm pronouncing it correctly. He owned 100% shares in Five Team Limited. See, this was a holding company. This was a holding company. See, Five Team was agreed to be holding company by the executive. They said, yeah, it is an holding company. Okay, it just hold the companies. The main thing came to OpCo. Okay, that is operating company. Nine Codes business was wholly either the question was either Nine Codes business, the one that Fighting holds. Okay, see, whenever you are going to look at what you are going to do, whenever you are going to look at anyone's estate, you are going to see the first set of company that they own. This was the main company he owned. Okay, you are sure as hell that this is an holding company. Then you move on to the downside. Okay, now you see this Five Team has 100% shares of Nine Code Limited. So it is completely owned by Five Team Limited. What we now need to see is because Nine Code Limited had the property called 16 High Holborn, okay, in London, okay. So this completely held this property, okay. We had this property available. So we need to see either the businesses that we have been carrying on in this property is a trading or an investment business. Okay, this is the main classification that we need to see. Okay, moving on to next to see the details of the properties. Okay, how the property really looked. Okay, so let me give you a rough idea how the property was. So let's say this is the property. Okay, this are the two floors. I had it done wrong. Okay, bear me with my drawings. Okay, let's say these are two floors. Okay, and these are four floors. Okay, anyone with sane mind will see that this can't be equal. See, this is two floors and this is four floors. Okay, just imagine. Don't go to my drawings. So this two floors, which were 11,000 square feet, were proper rental floors. See, the executor said that these two floors were doing investment activity. I'm just letting out the property and getting the rent in. Uh, okay, in as a property that we have been given. Okay, so we have been getting rent for that property, providing the space. Okay, so it was let to the tenants on an ordinary commercial leases for shops and offices. So it was given for commercial purposes, shops and offices both. Okay, the rental income, average rental income was 2,29,000 a year. Okay, 2,29,000 pound a year. You see how much is the income? Just estimate the value of the property. For two floor, the average rental income for one floor, it is per floor value. Okay, the average rental income was 2,29,000, and this is just for two floors. Okay, just estimate the value of the property. It is in London, anyways. Okay, it would be really high. Okay, so you see why we are really fighting for this, because 40% for this thing would be really a huge one. You see, millions of millions you are going to pay to IHT. So this case is really important. Okay. So both sides agreed that this was making holding or investment. This completely has been understood by both the parties. They accepted it. Yeah, we have been doing investment activity. The problem was with serviced office. The problem was with serviced office. See, uh, even with even if you consider as we saw, there are many factors. The turnaround time, the turnover. Okay, turnover. Firstly, we are going to see turnover. For turnover, let's say what was the revenue for both kind of properties. Okay, just let me go out of this PPT. So this is the original case book. Okay, This was the serviced office turnover. You see, the turnover 1575,829, big number. Okay. Okay, 15,75,000 was the facility fee. Your contract services fee, which was 377,606 for the last period. This is what we are talking for the 4 floors. The 2 floor is here. So if you see, the majority of the business comes from your serviced offices, right? If you see, the majority of the business is coming up from serviced offices. Now let us understand what are the kind of fees available. Facility fee, this is the fee that I am getting just because I provided the space. The space, I signed an agreement that this particular space is for your business. Okay, along with that I am going to provide certain services like cleaning, heating and all that. This is what we call as contract services fee. Okay, this is how a service business normally runs. You are going to provide, let's say, meeting room and additional things apart from the space that you've actually given as per the contract. So this kind of things fall into contract service fee. So we saw the facility fee and now we have contract service fee. Next one is turnover rental activities. This one is simple one. You get rent. Let's say for the property you have provided, and you get service charge. So whatever the service that you have been giving to the client, okay, let's say you are taking on maintenances and other sorts of things, would fall into service charge. But turnover wise, you see, because yeah, obviously we had 4 floors. Okay, we had 4 floors for serviced offices. It is higher. Okay, so with the materiality part, it's a major part of business. So the problem was with this particular area, with the serviced offices. The problem is with the serviced offices only. Okay. This was managed by another company, which was Orega Management Limited. So it was an agent, okay, managing property on behalf of 9 Court. Okay. Under the Orega Management, they had whole agreement laid out. You can check out in the PDF that we saw what was the agreement and what was the terms and conditions in that. I'm not particularly interested in that in this particular video because it will stretch this video too long. Okay, and you are going to run away from this video. Okay, so this was normally, so it had 42 offices. It was normally occupied by 7 to 20 firms at a normal time. This is where the whole case was turned. So the point of discussion is this particular area only. Okay, average facility income was 533. Okay, 533. Even with the facility fees, we saw the another angle. Okay, contract service fee, which was again which you could classify as a trading income. Okay, because you have been providing actual services. But for facility fee, there is some issue. We need to identify: are you going to consider it as an investment or trading business? Okay, so see, more than double the rental. See, the average income is double. Average income per floor is double for serviced offices. Okay, you have double, but we need to ask: was this just due to the premium for space, or this is the premium for the services that we have been providing? Okay, moving on to the next slide here. Clients pay two separate fees. Just we saw that table. Okay, we have facility fee, the income which is disputed. As I said, the contract service fee is easily identifiable as trading income. Okay, it is easily identifiable as agreed. It is agreed. Both parties agreed that this is trading income, right? Okay, this was genuine trading income. We do not dispute this. We are going to dispute your facility fees. Okay, what it covers, you give services such as meeting rooms, server space, IT connectivity, postage, catering, photocopying, etc., etc. You provide admin services and all. But what was facility fee? This was the income which was disputed, where we need to identify either it is investment in nature or it is trading in nature. So what it covered: facility fee. Once you give facility fee, what is the thing that you have been providing? So it provided a specific numbered office. Okay, you provided a specific numbered office. You gave a certain area. You gave workstation where the price per space was agreed. Okay, price per space was actually agreed. Standard hours, Monday to Friday, you will have phone answering, reception, heating, AC, cleaning, kitchen. So you see, there is something of both nature. You have provided space, but for certain part, there are services also included in this facility income. It's not completely just we gave the property. There is some active management involved here. But either this active management and services that we are providing is material for this overall business to become wholly and mainly a property trading business is what we need to identify. Okay, this was the income just we saw. Okay, so the parties agreed if the facility fees was investment income, the whole business was mainly investment, as we know. Okay, and the BPR won't be there. The case was mainly on this particular fees. We are going to fight on this fees. Okay. Next, the FTT rules ruled against the executors. What are the FTT's points? What are the points of FTT? This decision was raised 24th October 2024. So before 2 years, this thing was raised with FTT. Now it got in this year it got opened to the Upper Tribunal, and we got the judgment last month. Okay. Starting point: owning and holding land to earn income from it is generally an investment activity. So we just started off with a point. We are not saying in general that every sort of property is an investment activity. We just started that there is high chance whenever you own or hold any land just to earn income from that, that should classify under investment activity. What clients really bought. What we need to identify is that in our case, a fundamental part, a majority of part that the client paid for was for using the room, right to use a specific room. We got the money and we gave them right to occupy the room, occupy the space for a certain period. Okay. So the office space was the primarily element of the deal. So whenever you have a contract, you have a bundled contract. Okay. You have facility fees, you have serviced one. Okay. Now, how do you separate it? Even if you bundled it, the majority of the part the customer gave you was for the room the specific office area that they have that you have given to the client and that they have paid to you. Okay. Most facility fee activities were investment management. They said that see, if I am in a property business, I am actually going to advertise my business to sell it. Okay. I'm going to If I'm going to sell it, I have to market it, I have to advertise it, I have to negotiate terms, I have to maintain equipment, I have to provide it certain services. I won't give a room without heat and electricity. Okay, that goes without saying. So they said that this facility fees should be investment management. Okay, not a trade. So there was another case. The FTT has the facility fee did not amount to trading. It was physical space with some desirable areas, desirable extras. So we gave some desirable extra, but it does not really convert this whole case into a trading business. Okay. The conclusion was that facility fee should be investment income. So this was the conclusion that we got in the FTT's decision, that it is an investment business. So if the facility fee was investment business, it was majority part of the business, it considering the square foot area and also the revenue part, wholly the wholly business is for investment. Then it identified that. So BPR was refused. Okay, at that point. But executors had to think. Executors appealed for two things, that is error of law. They said that FTT misapplied the case law when it treated the facility fee as investment income. They said no. This facility fee should not be an investment income as FTT is saying. It should not be. They misread a point. They misread a point in one as per the previous case. Sorry for that. Okay, as per one of the previous case. They ignored that a building used for trade isn't held as an investment. Okay. Wrongly classified service package. They also said that the service package should be an investment income when services are classified as trading income. So they said that this one is the wrong argument that you did, the wrong decision that you gave. They failed to properly apply the former look at it in the round factors. So they did not look at the whole factors. As we saw, what are the factors that we need to see to consider the distinction between both of the kind of activities. Next is finding not open on the evidence. Findings not open on the evidence. So as per previous case, that no reasonable tribunal could reach this finding. The client's fundamental acquisition was the right to use a specific. They said the fundamental right the client had was to use a specific room. They said that there is not enough evidence. Okay, there is not enough evidence that they could reach at a finding that this the clients really actually paid fundamentally for the right to use a specific room. Okay, the facility fee conferred a right of occupation. They said that it was a right of occupation. They could move on. Okay, they could move to any other property if the business wants. Okay, that the income premium over the rental floor was partly about space and flexibility, not just services. Okay, they said, as we saw in the previous slide, what they said is that the premium has been just given because how the space was and the flexibility that contract had. But they said no, this premium is for something else. This is for the services that we have been giving to the businesses. So they said that most facility fee activities were investment management activities was incorrect as per FTT. The decision was incorrect. These are the two grounds of appeal as per the executors. With the upper tribunal, they again rejected certain things. No presumption, but no error either. They said that this presumption was just a starting point for this case. Trading does not equals to automatic escape for S1053, as we said, wholly and mainly. Wholly and mainly. Whatever you say, your business is wholly and mainly an investment activity. Occupation does not require a legal proprietary interest. The test is what a reasonable business person would call an investment, not property law. You don't fall into technicalities with us. Okay. The FTT's factual inference stood. The tribunal was entitled to find client's fundamental purchase was a specific room. The tribunal said that yes, they were entitled, the tribunal was entitled, okay, to have the fundamental purchase, to have the fundamental that the purchase was specific for the room, and the premium wasn't only for service. So all of those appeals failed. They rejected it. But one argument succeeded. Okay, one argument succeeded. What did FTT said in the first case is that if you provide heating, electricity, and AC, air conditioning service, okay, and other small services, you would be getting them into investment management, not as a trading. Okay. There was another case. We have so much case references. You can chat GPT it out. What was the case there? George v. HMRC draws a clear line. Property management, so finding tenants, maintaining the fabric of the building is an investment activity. That is correct. But additional services like heating and electricity should be in trading nature, should be in service, should be on the basis of you should consider it as a service business. Okay. So even if you bundle that, you can't deny the fact that the customer is paying somewhat for service fee as well. You can't deny the fact. So this is the only point that executors got their back off. Okay, they got the upper tribunal's back. Okay, but still, the main appeal was that they removed the whole error of the FTT's decision and they remade the decision, and rather than them sending it back, they reweighed everything. They again considered the weight of it. They considered all the factors, and it said that this particular mistake does not really mean that the outcome is different. Okay, a license to occupy a specific office remained the core of the facility fee, and that was still investment income. So still it would be an investment income. What was the final outcome? As we saw, they said that it was wholly and mainly for making or holding investment. Therefore, you won't get any BPR. Okay, you won't get any BPR. Okay. The tribunal found the facility fee was in substance a license fee. Okay. Whatever you say, the facility fee was just a license fee to occupy a specific office where you just layered something that you are also going to provide some services above that. Okay. That does not mean that it would tip off the balance of whole business. Okay. Named offices tied to room numbers on of invoices and secure fobs, priced by floor area, not by. So the services were priced because services were priced based on the intensity of the services instead of the area that has been occupied. Okay, long-term relationships. Okay, somewhere even for 2 years, as I said, more the short-term in nature, more it would be qualified as a trading business. Okay, services provided were unlikely to be material against that core. So for overall business perspective, the services had a really small part in that. Okay. Because the parties had agreed that the facility fee would tip the balance, the single finding decided the fate of the whole business. Okay. They both agreed that whatever the decision come was up to the facility fee of the serviced business. Everything was agreed. Everything was agreed between them for every area. Okay. The only question was with the facility fee, which was denied. Okay. What accountants and advisors should take from this? Okay. Serviced offices are not automatically trading. Okay. So even if you are running it well, okay, it does not mean you have been doing services, you have been maintaining it well, okay, everything you have been doing, it does not mean it would fall into trading part. Okay. The label on the fee does not matter, the substance does. What was the substance? Substance over form. The core principle. The core principle. Okay. So the decision was taken based on substance. Okay. Whatever the label you apply when selling, what was the actual substance behind it? Ancillary services rarely rescue a property business. Okay, so if you have heating, cleaning, reception, and similar services like that, they are unlikely to be material. So advise clients not to over rely on them for BPR planning. So as an accountant, you should advise your clients that even if you are giving services, they are unlikely to be material. So that would rule the decision against you. Structure and evidence matter well before that. How space is priced, invoiced, and marketed, and how much generally separate trading income exists will shape any future BPR claim. Okay, get specialist advice early. So this thing is really something that you need a specialist to sort out. Okay, this was a really complex case whenever we talk about it. Okay, next one thing is what we are going to discuss, the changes that we have got in the recent time. Okay, in the recent tax year regarding the BPR. Okay. So I am getting you directly to the actual law as per HMRC's portal, the new thing. What qualifies for 100% is relief, as we saw, if you have a business or interest in business or you have a shares in an unlisted company. But if the deaths are on or after 6th of April 2026, this 100% relief is capped at 2.5 million. So even if you qualified for BPR, if your property's value is 4 million, you are going to get the relief, the 100% relief at 2.5 million, not the whole 4 million. That 1.5 million would go for 50% relief. Okay, so unlimited relief for any value of the property has now been stopped. Okay. So what really qualifies for 50% relief? So as I said, above 2.5. So if my property was 4 million, I would be able to get 1.5 million at the rate 15%. So the relief would be 50% of that. Okay, that would be 750k. 750k. So for 4 million property, firstly I would get 2.5. 2.5 for 1.5, for the value of 1.5, I would get 750k. Okay, so 2.5 plus 750k would be the relief that I will be getting. not the whole, unlike earlier before 6th of April 2026, where you would have got whole 4 million as the relief. Okay. And 50% relief is available for shares traded on markets that do not meet HMRC's definition of listed, such as the AIM. So, if they are not considered as per the HMRC's definition of listed companies, they would fall under 50% relief instead of 100%. Shares controlling more than 50% of the voting right in a listed company. Okay, so if you have a majority right, if you're controlling interest in any company, any listed company, you are qualifying for 50% relief. Land, buildings, or machinery owned by deceased and used in business, they were in partner or controlled. Land, buildings, or machinery used in the business and held in a trust that it has the right to benefit from. Okay. What does not qualify, as we saw right now, what does not qualify? So if you are dealing with security, stocks or shares, land or building, holding investment, if the business is a not-for-profit organization, is being sold unless the sale is to the company that will carry on the business, and the estate will be paid mainly in the shares of that company. Okay. So this case is really important. So if you are even selling that business, even if you are selling the business to someone, you can get BPR, but that company to whom you are selling should continue continue that trading, uh, continue the same kind of trading that has been done. Okay. And okay, and the estate will be paid. So the compensation, the way you are going to pay to the estate is via the shares of that company. So estate is going to hold the part of shares in the company that is continuing the business. Is being wound up unless this is a part of process to allow the business of the company to carry on. Okay, if it is, you cannot claim business relief on an asset if it also qualifies for agriculture relief. So this is a separate set of discussion. We may do it later on. Was not used mainly for business in the 2 years before it was either passed on a gift or as part of it. So 2 years is a really important condition. If you had not had the business till 2 years, okay. So before your death, you should have that property asset before 2 years, okay, till 2 years. So if I had a asset at just say 2025, and I'm just and it was a genuine trading business, okay, it must have qualified. But since it was just 1 year back, I won't be able to qualify for BPR. Okay, I won't be getting any relief on that. So at least it should be 2 years back of your death. Okay, you should have got that business before 2 years of your death. Is not needed for future use in business. Okay, so this is something that you can look at. I think we have covered the agenda. Okay, we have looked the case. This is something that I tried. You would be knowing that everything's done. Okay, if you want to close this video off, you can close this. I just wanted to talk about something. This particular thing that really got into mind when I was reading this case, I thought we could have some changes in. We could have something new. Okay, this is something that nobody makes. Okay, this is something that nobody makes there. Reading a case is difficult. I read that case really, and you know that we haven't been releasing the videos, the normal videos that we have been doing for last almost 1 month, right? Because this case really took my time. I understood the whole thing. Okay, I had to revise my whole knowledge about BPR. Okay, and this was really interesting because when you just read a theoretical part, okay, when you read it on the books, you are just going to apply it into your exam. But when you see a case like this, you actually get the idea of why this particular thing existed, what was the logic behind that. Okay, so this was the only motto of me making this kind of video. If you like this type of content, I may keep doing such kind of videos going forward as well. Okay, I would try to put in such case at least a month or a two, such type of case which enhances your knowledge and also mine, to be honest. Okay, because I have learned so much from that. So I think this was the whole that we had for the discussion today. So have a good day. Thank you for watching, and keep sharing and keep learning.